guys, it's Monday, August 22nd, and there's only like 8 days left 9 days left in the month. And so you've really got a lot of really special dynamics going on right now that I think are driving this market way more than anything. And I want to start sharing my screen here just in a second. And give you kind of the overview. And then I'm actually going to give you a list of names that I just always have on my radar, because right now we're in this really bizarre in-between time. And once I show you the macro, it'll make sense why you really do need to have a list of names that you want to own in different ways. So we'll talk through that in just a second, but let me actually go through what I'm seeing here. The indices, to start off the day, it is completely red. And I was just telling David before I started recording that I'm like in shock because almost none of my names are anything but green. Like I always get really nervous when both my shorts and my longs are working exactly as they're supposed to, but I really shouldn't get nervous. It's just, I always worry the market gods will take it away from me. But here we are, all the indices down aggressively. What I'm seeing though, is that it's mostly the driver of a lot of this is these big cap names. Okay. On days when it's these big cap names, and you also have vacations happening pretty soon. We talked last week about the fact that now that options done, then you really only have this week to trade it before you go into Labor Day holiday. It is not confusing to me that you might get a lot of red screen. You might get people doing what I call taking exposure down. That's what the industry calls it, but I realize that's not the verbiage that folks outside of finance call it. But what taking exposure down means is that you're going to basically reduce your gross exposure. So if you're long and short, you're going to take them both down so that you just mostly have way more cash and you're ready to use that cash in September. Now, why would that be particularly relevant right this minute? It would be relevant because of exactly what I saw in earnings season, which I'm going to just kind of review. I'm at about 260 securities that I've listened to. You guys know I try to do a minimum of 400 a quarter of S&P names. I might also do other names. But given what I saw and given what's being said, it's a disconnect. So the professional community is not going to feel necessarily as bullish or bearish as what I'm seeing in CNBC or the powers that be. No shade on them. They have to create a show every day. I have to create a show every day. I get it. Okay. But if you look at the screen, most of the screen is red with the exception of very specific securities. Oil and gas is actually doing okay. It's more or less flat. And then some of your staples are more or less flat. So if you're actually more or less beta neutral or even net short, you're going to be green on the day to day and doing extremely well. And then if you have a certain tilt, you're going to be doing really well. So actually most of my day has been to try to neutralize some of the concerns I might have there and get some exposure to neutralize out my portfolio. Don't worry about that. That's really for specific folks that have hired me specifically to look at their portfolio in that way. But I just wanted to show you that because this is so big cap driven, that it really does look like to me people taking exposure down so they don't have to think so hard about their portfolio while they're on vacation. And that's an actual thing that typically would have ended up on my desk in the risk management area to try to figure out risk and analytics area. Okay, now let's actually talk about what's going on this week. You've got PMI coming out tomorrow. PMI is going to be really important for a lot of the big cap names. Additionally, you have PCE inflation coming out at the end of the week. We kind of need to know, but we already kind of know because CPI came out and those two aren't really going to be that different because no one is confused what's causing the inflation right now. Additionally, we have GDP coming out on Thursday. This is going to be way more important than it normally is because I'm sure at this point, I'm not the only one that is thinking the United States is holding us up as a globe, so to speak. So we really got to see what's going on with GDP. GDP numbers will also tell us import, export, some of that stuff, even though that's a little bit clearer when the actual import, export numbers come out. But you can get a sense for what precisely is going on, even though this is domestic production. If you then like think through how all the numbers are coming out. Sorry, that was probably TMI, and I probably should have said it in a more precise way. But this week's economic data is not just ignore it because it's not relevant. Right now, the economic data is a big deal. And I want to tell you why. We still have a few earnings coming out. I'm going to come backwards to that. When I did my earnings calls thus far, this number has washed around 54, which is now the low of, I'm at 365-ish companies on this recording that I pushed through. 54% were doing okay. And what I mean by okay, this is not beating the street. This is not none of that, because I can't use that. I'm a fundamental person when I trade options, which is a little funky. There's not a lot of us out there, but I need to actually know what the company did and has done historically. I cannot use these crazy estimates, half of which are stale in the system, because either the analyst wasn't able to update their estimate, so it's some rando average that exists before the analyst was able to update, or you've got a guy sleep at the wheel and has numbers that make no sense, or you got someone that's really too young to be an analyst putting out craziness because the number of analysts has just increased dramatically. I can't use that. It's not very helpful to me. It doesn't tell me anything about what's going on in the economy. So I do my own. I listen to all these every quarter, and I review exactly what they did in growth, operating income, cash flow, et cetera. I look through all of the documents. Believe it or not, weirdly, that is my training. But what I see is 54% are doing what I would consider better than okay. So either these 59 companies grew top line and then brought almost all of it down, if not more, by margin expansion to the bottom line. And here we're talking about greater than 20% top line growth, greater than 20% bottom line growth. And you know that this is essentially every single company within fertilizer, for example, and also oil and gas, the two areas that we're just having great difficulty. Now, the one company that is the exception to that is not technically fertilizer, because honestly, they spray all the nasty sprays that go on food so you can grow it. And that's really FMC. And I think that's what's taken the fertilizer companies down a bit, because their earnings report is a little cloudy in the way that they reported and discussed it. So that's something to kind of note. But quite frankly, it's looking good for those guys down south. The other thing that FMC reported that was a little funky for my names in fertilizer was that they were saying currency, this, that, and the other was causing them some grief in being able to maintain whatever it is down in Latin America. And I'm not, they literally are the only ones. I mean, Mosaic has been out that guy's not a young to this industry or young to doing financial statements. So the fact that he didn't say it and CF didn't say it, and really it's only this one company, is a little bit of a curiosity. I'll be looking for it, but honestly, we know who's not selling potassium phosphate or nitrogen for the next whatever period of time. And we're in August, and we're going to start to have to, the rubber meets the road in the next couple of months here for Latin America. So we'll know the answer to that very quickly. Okay. This 22% here, these are companies that are clearly not able to pass it through. Okay. So these were companies that had solid top line growth, but they had either they barely made, they brought almost none of it down, right? Or alternatively, they took a little bit of a lower growth rate, even though they're still positive earnings, okay? And that's that 22%. I need to see one more quarter to know that they're actually holding the line and not going to go into an L situation for the holiday season. These guys down here, 70, this like 30, 23, these guys are clearly not going to be able to hold margin. They're not, I mean, if some of these things don't resolve, you are going to start to see L's in 1 to 2 quarters. This was ugliness. And in some cases, it was a complete puke out. Now, I will say that down here, in this 85%, some of them did, or 23%, sorry. And then there's another 27 that I haven't reviewed it at all. Anyways, in this body of 87 companies, that's what I was trying to say, sorry. There are some that did kitchen sink additionally, and I looked for that. What exactly was it that made you miss your bottom line, and how was it? What happened between operating income and earnings, as well as did you just do it in some bizarro way, and here I'm seeing there are some folks that decided to kitchen sink because they weren't going to make the third or fourth quarter. So they were like, screw it. We're just going to start taking impairments left and right and seeing what's going on. I mean, look, it's not a fun thing to do. And there are constraints from an accounting perspective on what you can do. So it's not crazy, nasty, terrible, but it's there. And in that case, I would have rated them a little bit higher versus a little bit lower, because I could see clearly what they were going to do, but it was going to take 1 to 2 quarters to get through to this new paradigm that we're entering. What I would say as well is that some of these guys here in the middle, and also even a couple, but mostly it's here in the middle, these 79 companies, they made the quarter by reducing R&D, and they made the quarter by reducing CapEx. And to me, kind of am okay with that. I'm okay with that. I'm not great, happy, super excited about that. It kind of makes sense to do that. depends on your cash flow situation. It depends on what you have on the balance sheet. It's not the best thing to do, though, if your competitors are not doing the same thing. And in some cases, your competitors are definitely not doing the same thing. That would be medical devices. And I'm going to tell you, after this quarter is done, which I only have about less than 40 names now, I'm going to be doubled down on some of the medical devices because a few of them really crushed the quarter. And then there's a bunch that ate it on the chin, like a small little 2-year-old that's just learning to walk. I mean, wobbling like crazy. And it's beautiful because some of the ones that wobbled the worst blamed macro while their competitors are sitting there eating their lunch. You can't do that. Okay. You know what I mean? I'm not going to give you credit for it. It is what it is, but I get it. Again, I don't want to be too critical because the CEO job is a very hard one. You got to come on that call. You got to say what you got to say. And then you got all these really judgmental people that got to make a call, and it ends up dollars and cents for everyone involved. So I don't want to be too critical, but is kind of what it is. All right. So that's what I saw. This represents significantly more differentiation in earnings than I've ever seen. And like I said, with the example that I gave you in medical devices, and that's not the only example, okay? You see parts of real estate that are like that too. Huge swaths of technology are like that 100%. You see actually the REITs holding up okay, but there is kind of a mixed bag there as well. But the only industry where you could really thematically go for it is oil and gas. But even then, you really got to be careful where exactly it is they're drilling and what's going on. And then, like I said, with energy, there's how I feel about coal and which ones are going to do okay, which ones are going to do a little less. So this is a much more diverse quarter than I've seen since COVID, and also this is one where I would think that thematics, you might have one more quarter to get away with it. But after that, buddy, you better know what these companies do, because you're going to see a lot of dispersion as far as that goes. So that's what I'm seeing. Hopefully for the fellow value and fundamental people, that's exciting to finally be allowed to do your thing and not have someone just do something stupid on the trading front and then just smack you in the face with it. Now, we do have some earnings this week, and they're going to be fairly important. Tomorrow, we've got a couple. Medtronic is another medical device. It's going to, like, cardio has actually been doing slightly better. But I kind of need to see it still across companies and not know that there's just a share situation. So I will actually be listening to that one. And I'm very curious because Intuit obviously gives both insight into the mortgage piece as well as what they're thinking on taxation. So I'm actually very curious what they have to say. And then Smuckers over here, I'm always interested in supply chain and where they're seeing it, where they're not, since they have some exposure to food, so to speak. I'm going to be interested to hear what they have to say. But then, you got some big stalwarts reporting. You got Salesforce and NVIDIA. That's going to create a whole mess of fun trading for the day traders. Again, Rich, the Rich method, you guys check him out at gurula.net, gurula.app. If you just go to the website, you'll find him. He's fabulous. He's going to have a lot of fun, I'm sure, with these two names. And then we got Dollar General, Dollar Tree, and Ulta, which also are going to be fun to trade. Between the three, Ulta hasn't come in enough for me to be excited about it. It did trade down with everything else today in consumer, as well as I think people worried about it because of Estee Lauder, and they should not be, because the portion of Estee Lauder that did really well was the US market. And then Ulta didn't have the same skincare exposure that Estee does. That said, it's not like it's not cheap enough for me to be really aggressivo here. I have to kind of see what happens in the next few days and then make a call. And then Dollar General, Dollar Tree is going to give us insight to the lowest of low end of consumer, but also they do a decent job discussing what they're seeing on the macro front. So I need to kind of get into that as well. So no rest for the weary for me. Now, the final thing I'm going to say is I really have these things on my radar screen, and I've got things that I trade, and then I've got things that I just want to buy and hold because why not? Okay. Boring and dependable. One of the ones that I'm not even, my broker doesn't offer options on it unless I call them, and I'm just not interested in doing that. But FleetCor is a decent company to put on the radar screen. They're a 30% grower trading multiple EV to EBITDA or earnings, whatever's your favorite, because they don't have a lot of debt that is, given what they do, it's a little bit funky even if you look at the debt. So, FleetCor is one to look at and put in the portfolio for the long term. This guy has turned this thing all the way around. And what they do is they originally were doing more gift cards, but now they really do gas cards and lodging. So let's say you're a municipality. You got people driving electric vehicles, as well as they got put gas in the vehicle. You give them a card instead of taking in 1,001 receipts, and then that card is a fleet core card, and when they fill it up, it just goes directly off your account. This is incredibly beautiful with oil and energy doing what it's doing right now, because it also implies that you can stabilize your cost of gas, right? And also you can stabilize, you can kind of like Fleet Core actually can go into the market and hedge out whatever's going on in what people are paying them and so on and so forth. So they got a really beautiful model that you should take a look at. Here they're actually okay, but honestly, this is one you want to hold for the long term anyway. So just find a spot that you're happy with the chart, for the chartists out there that need that, and then don't sell it for a while, because it's good until this oil and gas stuff subsides, which I think is going to be a multi-year situation. And what I mean by that, it subsides in a way where it's a much stabler price, more stable price. I see people using this service. Now, for those of you that have no idea what I'm talking about, if you live in the city and you're a city folk like me, and you've ever rented a zip car or something like that, where they have a gas card inside it, that's Fleet Core, okay? So just so you know what it is. Pfizer, look, I'm going to tell you now, this thing has over a 3% dividend yield at this point. It's not even about the fact that I think that this company is massively undervalued given its cash and debt position, as well as the fact it's got a bunch of stuff in phase 3. It's trading the way it's trading because of COVID and the fact that it made so much money on COVID. Everybody's just expecting everyone with COVID to puke it out over the subsequent quarters. You know, if you want to see puke out, then go to your diagnostics folks like LabCorp and Quest, because even though they're great companies and they're wonderful, they look horrible cosmetically relative to previous years. And that's why folks on the quant side are doing crazy stuff to these poor companies. But Pfizer doesn't look like that. Pfizer's doing great. Okay. I have no idea why the fundamentals keep puking this out, but they do. And I'll tell you, I almost have a rule now for the last 20 years. I have purchased large cap pharma companies, especially that anything in the pipeline, when they trade over a 3% dividend yield and also have decent balance sheets. And I do that because they will ultimately continue to pay me 3% or more, and my cost basis will be so low. It's crazy. Like I have over 200%, 1,000% returns on some of the pharma companies I've owned for that long. So, you know, if you're a long-term set it and forget it, go ahead and find a place somewhere here in the 40s, because you're not going to have a problem with Pfizer. You know, usually when I buy these things at a 3 to 4% dividend yield, they got some kind of massive legal situation going on. And this isn't the case for Pfizer. So just be aware of that. And then Pool Corp, I've mentioned it before, their issue is they had a little legal run-in on antitrust. But here's the thing, Pool Corp basically is going to benefit no matter what. If you look at the numbers, they'll look beautiful. So because you're getting a discount because of this legal situation that's happening for them. It's already, the claim has already been made. The company's already gotten clobbered for it. And now they're just in appeals. So if they actually get that appeal, it'll be amazing. But if they don't, it is what it is right now. You look at the numbers and see what it is. Pool Corp basically, they make money on installing your pool, and then they make money on managing your pool over the course of years. That's what they do. And it's a beautiful business model, right? You're essentially paying them so that you can then pay them for the rest of your life, you know, and as long as, even though housing has been a little bit weak, which is the other reason they're getting clobbered, the fact is, we have a housing shortage. That's as simple as that. Number one. And number two, when people aren't buying new homes because of whatever, they're renovating their existing home. And Pool Corp spoke to that in the last earnings calls. But have a look and see if that meets your investment criteria as well. It's a great company. And right now, because of that legal settlement / appeal, is trading a little cheap. Now, there is a bunch of stocks that I'm thematically holding because of stock buybacks and because of dividend yields and because they're just living large on a very specific set of macro that I think is multi-year. And that is these names. Devon Energy, I've mentioned that so many times at this point, I must be like the biggest broken record, but I will one day just do a Devon Energy video one day on the list of things. Mosaic, you guys know how I feel about that. They're going to buy back their stock, period, because of given their growth, top line and bottom line and cash flow, and what it is their deal, and the fact that that sell from the Brazilian holder. can't remember it. Anyways, because they had that secondary early in the year, I think they've more or less bought most of that back, quite frankly, but they're going to keep going. So that's Mosaic. CF Industries as well is having a particular dynamic that is very positive for investors. It's on the nitrogen side. It's going to just make money. Welltower is one I rarely mention. This last quarter is really good. Okay, what Welltower does is they call it a healthcare REIT, but it's senior living is what it is. And during COVID times and even currently, there's been a whole mess of stuff going on in senior living as people rejugger the new rules. But I feel like on this last call, even more than the other two that I typically love so much, Welltower is really coming out of this like a champ and posting great numbers. So take a look. Remember that because this is a REIT, you have to look at FFO, not earnings, well, you could look at EVD, but really it's FFO, which is because you've got some sales of assets and it's going to look really funky when you go through everything. But Welltower is yielding you 3%. And I think it's free and clear of some of the stuff that was causing problems before. Its occupancy rate is really improving dramatically. I'm intrigued here, given what it's trading at. Icon Enterprises is the final one. Icon is kind of an icon, for lack of a better way to say it. You got to take a look at who he is. And I do owe you guys a video on this, but the major cash flowing component of this very high dividend yielding stock is the refinery business, which, by the way, refineries are always attached to a fertilizer. So they are also, a nitrogen business. So they are also producing nitrogen, but it's only about 5% of that whole mess of what he's calling the energy piece of his business. So it's not the biggest piece. Nonetheless, that thing's going to be fine to give us money back as shareholders. Note that if you are an Icon, you have till about mid-September to decide whether you want cash money or you want more stock. So that one's one to take a look at as well to see if it meets your investment criteria. These are not trading names. People will trade them. Don't get me wrong. Icon right now is getting a little clobbered. It's not actually getting clobbered, okay? They just issued their dividend. So basically shareholders of record prior to the 19th, whatever that was, Thursday last week, something like that. If you were shareholder record, you got basically dividends or cash. And so it's basically traded down associated with that. And say la vie, for lack of a better way to say it. So whenever the dividend is produced, it is a buying opportunity. It does also mean that the traders are going to do some silly stuff to it during that period of time. So, I would just watch it. I'm slowly accumulating it in this market weakness. If it continues for a couple of days, well, I'll just accumulate more because that's the juicy dividend yield. Now, these are risky, okay? I'm just going to say it. These are risky, but these are names that are on my radar screen. Activision, I think the deal goes through. And if you think the deal goes through, the way to do it is a calendar spread, in my opinion. I'll try to go through that. But let me tell you, you shouldn't be doing this with the money that's going to pay for your kids' college education. Okay. You got to do this with your speculative money. But essentially, if you buy the 85s back in March or February, people think the deal should get done, or he originally was saying the deal would get done in the fourth quarter. We shall see. But if you want to be a little bit farther back, March, February, then you could buy the 82.5s, the 85s, and then you sell October or November. Just make sure that you collect at least whatever the spread is on there. If you're doing a calendar, then, that could go to zero. So you gotta be careful on that too. But either do it as a calendar with October, where you're not at risk that deal goes through. November, kind of have to, smell out what he says on the quarter as to whether or not there's risk that it goes through in November. And then you're essentially just going to recreate that call option by having the front month pay for you, knowing that the front month isn't going to necessarily have anything but stay squat where it is, because these things trade at a very specific spread. That spread indicates what the market thinks is going to be the risk associated with it. That's going to be a function of market volatility as well as regular volatility, quite frankly. Okay. And there's reasons for that, but a lot of people say a little different. I know it's probably a little bit much for this call, but Activision, diagonals or calendar spreads. I prefer diagonals personally, but calendar spreads, technically, if you're doing October, should be okay as well. And you can see what the payout is, because that deal will be done at 95 if it gets done, and there's no other weird announcements. The other one is Fortinet, ticker FTNT. No idea what, I mean, here's the thing, valuation always sucks on this one. Somewhere in here is probably a decent place to just own it and know that you're paying a little bit much because it's going to trade at 2 times EV to EBITDA to growth, earnings to growth, something like that. And this is basically doing cybersecurity, and they have some of the bigger contracts with the US government. So Fortinet, very little risk to earnings going forward. With that, I'm going to hit the pause button, but that's always on my radar screen. Find a good place on days that are red and try to just own these and know that you're not going to let go of them. Any questions?
Anyway, very, very good info. Anyway, the S&P ran up to the 200-day moving average, which is pretty much the mother of all moving averages, and fell.
Yeah.
This 2% inflation target seems like a pipe dream. So,
well, there's timing on that. There's timing on that, David.
What?
There's timing on that. His time horizon is like the future. Do you know what I'm saying? Like
he's thinking in my lifetime.
All right. Remember.
There's no way, but your oil, fertilizer, all that fits into that narrative that he's not going to be able to get to 2%, meaning he's going to have to raise rates to even,
well, because I know your time horizon, we're really talking about the last quarter. In the last quarter, I think he's actually close to 4.5%. I think that the 2% target is for next year, tail end of next year, because he didn't really specify per se. That's why I thought the FOMC meeting was so crazy. But the 2.5.
The market ran up. What, big tech, Apple and Microsoft? I mean, they're very, very sensitive to higher rates. Rates go up, they go down.
I mean, yeah, I need another quarter. For a while when they first came out, I was still Google's run up a bit because they got beaten up. So they got harassed. Okay. I don't know another way to say it. They got seriously harassed, even though they did make money. Now I think the bigger thing is currency risk for them. Salesforce actually was the first to come out on currency risk. I was looking at my old videos, and then everybody subsequently came out and said a little something about currency risk. But in fairness, it didn't really affect earnings the way that you would have thought. So really, with every passing quarter, it's very unclear exactly and precisely how it plays out in the market, all of the craziness that we're experiencing. Because the one thing that hasn't played out yet is that Europe is still spending and acting like it's not at war and that it doesn't have a shortage going on. So once it does, it's unclear what part of which market is going to do what. And if it affects the currency markets, it could actually be problematic for the large cap tech guys. But if it doesn't, then in fairness, some of their business models, even if they're a little bit weak, aren't going to show terribly,
Right. I mean, guys like Mike Wilson at Morgan Stanley, he's calling for 3,800 S&P, and he's been consistent on that for, this
you're
whole
feeling a very particular way about this right now.
Well, yeah, again, technically speaking, it ran up there, bear market, it rallied hard to the day moving average and failed. I mean, that's how you, except for oil and except for your particular stocks.
I know how much
the narrative is going to be negative, I think.
Yeah. Okay. So, that was the weird thing. And I feel a little bit bad because I should have been more aggressive. Like, clearly last week when it was asked twice, I was like, I don't want to be long Boeing, I'm short Boeing, right? So what I feel more comfortable doing is only shorting the securities that I think are going to be a hot mess, because some of the challenge we have in the fourth quarter is that some of the companies may start to show some of that infrastructure bill from last year, which is crazy to think about, but it was last year already. That's why I was scared to do anything with John Deere. Now, today is the kind of day where you have to feel stupid for not just shorting massively aggressively. It just happened to work out for me because the names that are doing fine today and the particular mix that I have is showing results in a green portfolio. I don't know, because we got the end of quarter coming up very quickly. You know what I mean? Like, to do end of quarter weirdness on Monday, for the last day into a holiday would be very awkward. And then, you know, it's timing more than anything. But I think that the market just trades highly volatilely, but once we all look back at it historically, it'll almost look sideways until we get another set of data points. Because the weird thing that we have,
I don't see the market going up with rates going up.
well, I think it's range bound exactly to that same point until you get a little bit more range point. Okay, range bound is slightly down if I'm honest with the world, right? Okay, so like obviously energy sector is going to become a bigger part of this S&P 500 before it's all said and done. And I say obviously, but maybe it's not obvious, to be fair. The banks oddly weren't that weak this quarter. They still continue to show strength, and it's crazy, as well as the entire housing sector. So it won't take much for this thing to turn on a dime. Do you know what I mean? So I'm scared to short it in any kind of meaningful way, you know, because.
Okay, but if rates are going up, multiples have to come down. You're an earnings person.
Yeah. I don't know. I'm gonna hit pause on that because I want to think through it more fully because really if he's at 3,800, we're talking about a very aggressive, sharp downward movement over the next, you know what I mean? Right. Like if he was at like 4,000, I'd be like, all right, whatever, you know what I'm saying? He's at 3,800. So it's like, it's a little bit more, I mean, okay. So if most of that comes out of big cap tech, maybe, but like, you know, even Tesla,
that's exactly where it's going to come out of. I'm not talking about oil or, I mean, I agree with all your picks. It's just big cap tech is going to be hit with high rates.
Yeah, I mean, I struggle to short Google. You know how I feel there because at
short Amazon.
Yeah, Amazon. I took a short position in Amazon on Friday because I was like, I need something to hedge with, and also if everything's going down. And for whatever reason, I got enough volatility to short it a little bit farther back where I like to short it. Apple, I'm always scared to short until the holidays.
No, not Apple. Short Amazon, short Meta is that's almost a sure.
Meta has dropped so much from where I shorted it. I actually started covering it today. So I don't know what to do. And then let me see what else is. Let's go. Let me look at here. Let me share screen so we can all look at it together. So Tesla here, I'm scared to short it here, to be fair, because it wasn't a bad quarter. Even though Elon keeps coming out so negative, it wasn't a bad quarter. Microsoft, I'm actually afraid to short here as well because they really more than one of their business, like most of their businesses are doing okay. Google, I struggle, you know, somewheres in semis were very mixed this quarter. So I am going to stay out of it as relates to NVIDIA and let the data traders do the thing.
Yeah. Never sell dips, sell rallies.
Yeah. Yeah. So I'm not gonna touch, no, but either way, I don't want to go long or short the semis right now because it was such a mixed quarter. Some of the semis really crushed it and some of them did not. Like Intel, how much I wanted to love that name, but boy, did they let me down this quarter. I should have went ahead and bought puts on it because I was so upset, but I didn't. Unfortunately, it's down 4% today, so I'll live to regret that. And then, you know, if Berkshire just broke 290, if it continues downward, I will take exposure. I will go long Berkshire, not short, given what it is. And I'm a better buyer of MasterCard and Visa on top of it, even though I'm not doing it in any kind of meaningful way right now, because I am worried about what's going on internationally. But both of them keep defying gravity as far as not so much, they don't defy gravity as stock, they defy gravity in what they're actually seeing. And I think it's because they're taking market share from physical currency. Do you know what I mean? Like everybody wants Bitcoin and all this other stuff. They forget that these are the two largest fintechs that you really have is MasterCard and Visa. Okay. So they will take share. PayPal, you know, I love shorting it. I was shorting it last week when it was rallying like crazy. I told you had no business over 100. So therefore I was shorting it pretty hardcore. Yeah.
Right. It rallied, you shorted it. That's perfect.
Yeah. It's got no business over 100. You know, the other ones, it kind of is bank by bank. It's a really strange thing. I don't know. have to think about it. For me with the index guys, they're so good at what they do in their craft. It's hard for me when they say 3,800. That's a bold thing that I don't have like stock by stock. I'll tell you how I feel, but I can't ever tell you indices. That's why I always come to you.
Well, he's basing it all on earnings multiples.
Yeah. Yeah, I can't do it in that one way because the thing that's really weird this quarter about earnings multiples is because you really had some people eat it. You know what I mean? Like Meta's earnings multiple, like you can't even do it based on multiples. Here's the thing, like I can't do it on a multiple because I also need to take into consideration the growth rate. So if I do earnings multiple to growth rate for the entire S&P, that particular math, I know, because the other thing that oddly enough I do is I teach data science. I can't even justify it as a data scientist. So I know that that's a BS calculation when I go to do it off of 500 securities that have that diversity and dispersion. I know better. Okay. I know, like I understand a basic concept within statistics. So as a result
growth
of that,
multiple on Meta, what, the metaverse?
Meta,
How
Facebook.
would you do growth on the metaverse?
The problem is that you can't, when you do the PE multiple, you get one thing, but you realize they're going to take a negative earnings growth rate for the next, and they're literally going to redistribute all of their income to transitioning their business model. And we don't have a great sense for how long that's going to take. When you realize that, it almost doesn't matter how low the earnings multiple is, because he's basically going to take all that earnings and redistribute it back to growth. And so that's so that's why the dispersion across how you would think about. So first of all, I hate, as you know, and I've said it before, I hate using just a regular earnings multiple. Even if you use, I prefer enterprise value to EBITDA because you remove all the weird banking stuff. But even then, I really need to understand the growth rate to make sense of those numbers to begin with. And because if I were to do a PEG ratio or EVD, but whatever you want to call it, a modified PEG ratio to the S&P 500, I can't do it. And I can't do it because the dispersion is so crazy. Also on the negative side, because the growth rate's going to be negative for a couple of these people as relates to earnings or operating income or anything that you want to use to demonstrate how these companies are going to redistribute cash back to shareholder. So because I can't do that math with any kind of meaningful, like I can't do that, look myself in the mirror in the morning and say that, hey, I'm a fundamental person, because it's a load of malarkey is what it is. As a result, I can't, any of these people that are doing on a multiple, I don't know, I feel like you'd be better off with a dartboard. You know what I'm saying? Because Microsoft legitimately is trading at a low peg. You want to do enterprise value to growth, all that stuff, they're going to be just fine. And they don't have this need to massively rejugger the business model in order to make it happen. Same thing with Google. Apple has a little bit, but I have a feeling they're going to figure out a way to either make it up on sales or make it up on supply chain because of what we're now seeing in semiconductors. Amazon, Amazon already told us it was going to be disaster in the third quarter. So it is whatever you think the market's going to do, and then whatever you think is going on in the fourth quarter. And Tesla always trades at crazy multiples to growth. And quite frankly, as much as he cried wolf as bad as this quarter was going to be terrible, this was a good quarter for Tesla. So when we do that little analysis of big cap tech, it's hard for me to be like, oh yeah, let me use a PE multiple and set it to indices, because this would be the one quarter, especially given that what I'm saying is this is what I saw, right? Sorry, let me see if this slide will come back and pay attention for me. Sorry. I don't know why my little graphic isn't coming up. But if I'm saying 54% of the companies are doing, if I'm saying 54% of the companies actually did pretty good, and then the other 46, then there's a bunch that really coughed it up, and then there's a bunch that I'm just like, I don't know how to think about it. Then what I'm saying is that there's a bunch of companies that the dispersion is just crazy this quarter. Well, I can't be using a multiple, because that, if you're a mathematician using that, you should know better. Shame on you. I don't know another way to say it.
The risk you run with the big caps is, they're indices sensitive. So, if the S&P gets clobbered, they're going to go down with it.
Oh, that's true. Like if people are just like, I'm hedging out, I'm just going to sell indices, then that is what it is. And that's a fair point. Okay. I give you that 100%. But that's a very different point than an analyst trying to pretend like he's going to do some kind of average multiple nonsense over the year. He should know better, because that average has dispersion like it's never had before. We just haven't had that. It's been mostly like you'd be able to do sector plays before. You can't do no sector play right now except in energy. Sorry, my grammar's gone to pot. Let me try to be a little less casual here. You can't do a sector play. I think it's very dangerous. You can still do whatever you want to do, but it is quite dangerous right this minute to do a sector play, except in energy and specifically fertilizer. Any other questions? Hey Sterling, how you doing?
Hi May, how's it going? Good to see
Good.
you. Hey, I got a question for you. You mentioned about Apple, right? And one of the things that I'm trying to see is should I be looking into anything with the Foxconn Lordstown Motors partnership? Like now they're going to be, Foxconn's going to have, brick and mortar here in the US to assemble? Like is that could that be a play to move part of the assembly here and then for you know Apple to reduce to minimize the risk to their supply chain? Should I be looking into that, or is that just my like
I mean,
a
if you want
crazy
to,
theory?
like in general, a lot of manufacturing is, as you know very well, because I know that's your bread and butter in some ways too. Like a lot of that stuff is coming back on shore, especially because of the China risk there. Now, the one thing that I would say that is kind of relevant and kind of interesting, because I personally have not looked into that specifically yet. So I'll go ahead and admit where I haven't done the work, as far as that goes. But the thing that's really nuanced that I'm looking for in the fourth quarter, okay? So not the third quarter that will come out, I will start to smell a little bit of it towards the back part of that, is we do get through this whole China situation because he gets confirmed and all that other stuff. And it'll be very interesting to see how he decides to play it as soon as that happens. That's going to happen circa November, December. So you got to be like, if there's, it could go either way. It's unclear right now, the writing on the walls. Also, this administration has got the weirdest China policy I've ever seen. The way that they're playing it is so awkward, in my opinion, and so different than past administrations have been. If we get any kind of benefit on the China side, it will absolutely impact what you're asking specifically, as well as the whole market. I don't know if that answers your question really indirectly or in a terrible way.
No. I get what you're saying. I'm following along.
Yeah. So I'm a little bit, China is a wild card right now. And this administration has not done anything to make it easier for us investors. Although I got to believe that there's people that just know diplomacy. Diplomacy is its own craft. I get it. You know what I mean? But boy, from an investor's perspective, China, what it was doing in the early part of COVID, what it was even doing earlier this year, and how we should think about it. I'm like, even the beginning part of this year, I felt more comfortable talking about BABA and all this other stuff. I don't feel comfortable at all, because we're really coming down to the wire, and it could take a sharp left turn, or it could stay in the same direction that's going in as we get closer and closer to that event.
Cool. Thanks for your input.
Yeah, no worries. Any other questions?
May the event being what, the election?
It's a confirmation, I think. I mean, he's going in. Come on. There's not going to be another, but it's some of these lockdowns people are thinking are a function of that. Versus, I mean, people say that's a conspiracy theory. However, wow, what an interesting conspiracy theory, right? You know what I mean? You can't rule it out at 100%. So if we have a massive reopening, and you think about how much of the global marketplace has been doing it without the Chinese traveler, and with a more modulated and muted Chinese business international situation going on. We already know that the country is going to always attempt to make sure it has great food supply. So that's part of the reason why they're not going to be giving off any fertilizer to anyone for a little while, but they could. Historically, there have been times, in fact, not just even historically, that was where Australia got all its potassium phosphate and nitrogen from, quite frankly. I mean, nitrogen, they do a little bit, but potassium phosphate, they're an importer like crazy. I think 60% came from China. But but largely speaking, they haven't been giving the world any of theirs because they'd like to feed that population and come off a one-child policy like champs. Additionally, we don't know exactly what's been going on as relates to their energy purchases. And I've got some hints, for sure, because the energy companies are no dummies and they've been telling us who's been buying that Russian oil and gas. So, there's that. So we know India, big buyer right now, as well as potentially China, but it's all been done very modulatedly. So we don't actually know when they open back up what precisely they're going to do. We got a president that's doing all kinds of intriguing things. That's why Ball Corp got clobbered, because everybody's really worried, and we're starting to see it, of what's going to happen with China as relates to, because what China does on the manufacturing side, especially if it's got, especially if it's short up its energy, is it just starts subsidizing major industry by lowering the energy price for everybody, which in this kind of market could be the kiss of death for us. So we got to really watch it in that fourth quarter. Do you know what I'm saying? We got to really watch it. And it's unclear what they're going to do at this point. So that would be the one thing. Sorry, maybe it's not the only one thing, but it is a thing that is not a zero probability event. Maybe I'm a little conspiracy theory on that. I'll give it to the world, but it's not a zero probability event.
May, do they have much energy storage in China?
I don't think anybody really ever knows the answer to that, but they definitely buy the living daylights out of it when they can on the cheap. Like when oil was at 30, you better believe they bought a bunch of it then.
Gotcha.
And let me tell you, just to be crystal clear, China is so bright. I mean, it's such an intriguing country. If I was a young person, I really wanted to study something specific. The way in which they handle and think about long-term issues is just next level. And as an American, we're patriotic as much, but I still gotta study what other people are doing. During the first few quarters of COVID, there was a ton of our industrial equipment that went to China. PACCAR, Cummins, all those hydrogen engines, that's how they made their quarter. So, they are very, let's call it opportunistic buyers of different things. So I wouldn't put it past them to be trying to keep that storage full as far as that goes, and if not even putting up storage. And then the Chinese have a way of construction that's a little different from the way it's done in the West. It goes up a little faster,
What happened? Yeah, that's interesting. You brought that up. What happened to the real estate market?
Okay, that's a disaster. That's fair. What I think is actually happening, and I mentioned this a long time ago, was that, did I mention this? I don't know where I mentioned this. I don't remember if it was on a video or if I had done it. Oh, you know what? Actually, my most recent crypto video, you can take a look. It's called Multiplier Effect versus, so it's on my Markets with May YouTube channel, but it's relevant for all liquidity issues, related issues. But it's the second video in my, just look for my crypto videos. I think it came out this last week. But a thing that's not understood about liquidity crises and liquidity in general and the multiplier effect is how you take care of it if there's a problem. If you have an issue on the real estate market, what you do if you're a rich country is you try to slow down when that debt is due. So you just try to extend that out. And we've seen that ever since Evergrande, right? So what they've done is they've just termed out that debt to slow down and allow GDP to come up or do whatever series of things so that the impact is it's like an explosion. Right? If you can slow down the explosion, or you can buffer the time or something, I don't know. I feel like this is a sci-fi film, but I feel like you got me on the analogy. But that's what they'll typically, if you're a rich company, that's a country, that's what you should do. And that in fact is what I'm seeing them do.
Cool. Thank you.
By the way, we're also seeing it in Russia as relates to how they're dealing with their issues right now. But have a look at that video. I know that makes perfect sense to you. You just prompted me, David. And Sterling, I know you might know some of that, but it might be fun for you to take a look at it. Any other questions?
Thanks a lot.
All right, guys, let's get back to this crazy trading environment. Good luck. Talk to you later. Bye.